Gold and silver have seen some volatility, some pretty big trading swings in recent sessions. Of course, that was all after hitting record levels. Should investors be expecting a rocky ride going forward? Joining us now is Bart Melek, Managing Director and Head of Commodity Strategy at TD Securities. Bart, there was many days when things were happening. I thought, I need Bart here in this chair every day on days like these. Let's start with gold. What's the story here?
Well, we've seen some very volatile times for gold and precious metals broadly. Fundamentally, me and the team still like gold here. We're looking at a $5,000 quarterly average next quarter. May not seem like a lot at this point, given where prices have been and where they are. It was more of a brave call a while back. But still, fundamentally, it looks like from a trading perspective, we might hit levels significantly above that 54, 55, maybe even 5,700 is in the cards, just given historic volatility. And we certainly have seen a lot of volatility lately. And why do I think gold still has a bid underneath it? Well, starting today, we had the Chinese officials tell their bankers to maybe not be so enthusiastic in buying treasuries. That, I think, in no small way, had an impact, a negative impact on the U.S. dollar. And we all know that there is a very strong inverse relationship between the two. The weaker the U.S. dollar is, typically, gold tends to do better. Again, from China, we had news yet again that last month their central bank didn't buy a huge amount of gold, but continued to acquire gold deposits. And we're seeing central banks around the world continuing to do so. Now, going forward into mid of the year, it's very likely that we're going to see weaker economic data on Wednesday, a little delayed, mind you. We're going to have payroll numbers. And if we do start seeing data that shows us that there is a serious problem in the U.S. employment market, it would not be unreasonable at all to expect the Federal Reserve to tilt towards their maximum employment mandate. And what does that mean? That probably on the short end of the curve, we're going to see lower rates. We're getting a bit of a steepening of the curve as well as rates on the longer end go higher. And that's typically been a very good environment for gold. So the worry globally is that U.S. inflation will be above target. At the same time, interest rates will likely move lower, and that means that over the long run, gold is in a better position than, let's say, treasuries to give you real returns or preserve your purchasing power.
So there's a fundamental story, and then perhaps the argument that we could go higher from here. I got a feeling if I asked you if it was going to be a straight line, you'd probably say no.
No. It's very, very rare that these moves are in a straight line. I mean, we just have to see the previous 2 Fridays ago, I guess now, events of what happened. We've had a massive decline, not only in gold, but silver and PGMs and copper. So it's very rare, I've never seen it, that we go from the lows to record highs uninterrupted. I think it's always messy. And, do we see much, much more upside than what we've seen? Probably not. But I think the important takeaway is here, probably gold is going to trade around the 5,000 level for the next year or two. It seems like. We have it trending a little lower in the second half, but still, it is around that new magical level of 5,000. And we're also expecting the cost structures to move higher.
I want to get into silver. You mentioned it there because that has been, even from the price action, even a wilder ride in terms of the day when gold was getting hit, and I think it was about 2 Fridays ago. At one point, silver was down 30%, then jumps 16% in another session, then pulls back 12%. That is whipsaw for a commodity. How do we start understanding the moves in silver?
It has been very volatile, but it's no accident that silver sometimes is called the devil's metal for traders. It is historically twice as volatile as gold. And what does that mean? Historically, when you look at the data, when gold moves 1%, silver can move double that and sometimes more, as we've recently seen. So what happened with silver? Well, we had a parabolic run to the upside. The fundamentals remain pretty much unchanged. We're still looking at some 80 million ounces of deficits, and that's the difference between mined metal, recycled metal, and what is being consumed. But when you add the investment component, retail investors, ETF investors, then that deficit can be a lot wider. And for a while there, we had a situation where, well, retail investors were on fire, very excited
to be
about
on the
silver.
trade, right?
Absolutely. So that tightened the market on the short end quite a bit. Prices reflected that, and then we had some speculative action in the derivative side. My understanding is we've had players almost in a coordinated effort. I'm not sure there was any coordination, but sometimes it seems that way. And the market impact was that they were buying call options of ETFs that are publicly traded. And of course, if someone is issuing them, a market maker, they don't necessarily want to take a directional bet. So if they're issuing call options, that means they're kind of short. So they go into the market and buy physical to get the so-called delta neutral. They don't want a lot of price exposure. They just want to capitalize on the margin. And that created a lot of folks specializing in derivatives, a gamma squeeze, where basically the market got squeezed because folks had to go into the physical market, try to offset the risk from their options issuing business. And that, I think, in no small way has precipitated that parabolic run. We also had all sorts of investment in 2-3x instruments that were levered up. And then, shouldn't be surprised, Mr. Trump contributed to ending the party for a little while when he announced Kevin Warsh potentially to be the next Fed chair, rather, and his reputation is that he is, while on board with the president and agreeing that maybe we should see short-term rates drop. But at the same,
a bit of a hawkish history with him. This idea in the market that he will maintain, the dependence of the organization.
Well, exactly, and the market judged that he may very well be, in agreement with the president and ease monetary policy on the front end. But at the end of the day, everything that he's done in the past suggests that he is an inflation hawk, meaning that probably he won't be irresponsible in managing the central bank. And while I don't think that announcements change the forward expectations of inflation or anything like that in any material way in the bond market, I think it certainly triggered some folks in the more speculative side of the precious metals, where they said, well, if we don't see that debasement trade continuing, maybe I'll take some profits. At the same time, almost, we've had the increase of margins on the CME, for example, and then that momentum, that squeeze abated, and we dropped. We've since moved to around, I think today, $80 or so. And I think that's where we are. Fundamentals haven't changed. We are still in a situation where supply is being outpaced by demand. And if we continue to see investor interest, that'll be more of a case, which means that we're operating above the industry's ability to supply the metal. It means that inventories on the LBMA, which was squeezed, and other sources will have to be employed to balance that market. We need to remember silver, copper and oil, all those commodities, they're physical. You can't consume more than exist. No matter how much you try, you either produce it or you use up inventories. And in this case, you're going to be using up inventories, and that means the price gets determined by the so-called discretion price. At what price am I as an investor willing to give my marginal unit or an industrial holder of those metals? And that's a very difficult question to answer because we simply don't know.